What's up guys, my name's Curtis and welcome to 5 Minute Finance, where I take personal finance topics and explain them to you in 5 minutes or less. When you borrow money for whatever reason it might be, there are generally two different forms of loans, installment loans and revolving loans. Installment loans are generally pretty easy to identify because they have a predetermined length and end date. These loans come with clearly defined terms, and if you ask for it, you'll be able to see an amortization schedule. This chart would show you, for each payment that you make, how much of that payment is going toward interest and how much is going toward principal. It will also show you what the remaining balance will be following each of your payments. Some of the most common installment loans are things like mortgages, auto loans, and personal loans. Revolving loans, on the other hand, are things like credit cards or lines of credit. You have a set maximum amount of money that you can borrow, and you can continually borrow more and more money so long as the balance doesn't go above that maximum. Since you aren't borrowing a set amount of money with a predetermined length of repayment, revolving credit can be a lot less predictable. Your monthly payment is often a percentage of the total balance that you have taken out, so your payment can change month to month. So, although I'm not a huge fan of non-mortgage debt, when it comes to installment versus revolving loans, installment loans are almost always the better choice. The interest rate on installment credit is generally much lower. For example, mortgages may have an interest rate of 3 to 4%, while your credit card could have an interest rate as high as 20% or more. Also, installment loans are very predictable and you know the exact date that you will have them paid off. Since revolving credit generally has minimum payments that are proportional to the amount of money you have borrowed, as you pay down the balance, your monthly payment may also go down as well, which is designed to keep you in debt longer so creditors can collect interest over a longer period of time. Lastly, with installment loans, you often have something physical that is tied to that loan. In the case of a mortgage, you might owe $100,000, but the house could be worth $150,000, so you're not underwater at all. With something like a credit card, you could pay for a bunch of things that are quite literally worthless the moment you swipe your card, such as going out to eat. In cases like that, you could end up in a lot of debt with nothing tangible to show for it. The only main downside that can come with installment loans is that sometimes you may not be able to prepay the balance, which can lead to some inflexibility. But this can easily be avoided upfront if you just check that there's no prepayment penalty. It's for those reasons that, in my opinion, installment debt is much safer than revolving debt. I'll always encourage people to stay out of non-mortgage debt if at all possible, but if you do need to borrow money, just be very careful when it comes to credit cards. If you can't pay off your credit cards every single month, don't use them. Also, if you're going to use an installment loan, don't buy things based solely off of the monthly payment. I swear it seems like you can buy just about anything that you want these days with just a few $100s per month, but in no way does that mean you're getting a good deal. Always buy things based off of the purchase price, not the monthly payment. I hope this video helped you guys understand the difference between installment loans and revolving loans. And if you liked the video, it'd be great if you gave it a thumbs up. If you're new around here, consider subscribing and hit that notification bell for more videos in the future.